Hello everyone. I want to begin wishing each of you all the best in this time of global crisis, opacity, hence uncertainty. The economic impact of the pandemic crisis is a complicated story, and we don't have today all the inputs to make any reliable, definitive conclusion. Prudence is required. And that's why I will tackle only two very specific issues. Number one, the impact of budgetary stimulus on public debt in both developed and developing countries, and two, what might be the consequences of rating agencies' policies precisely on the financing of budget deficit. Well, clearly, the volatility index shot up in the first few days of 2020 abruptly, given that the pandemic crisis took everyone off guard, including bankers, managers, the government, the military, the World Bank and the IMF, you name it. And in fact, there are two types of crises. Type 1 crisis emerges brutally, but its timing and scope cannot be anticipated precisely. That's the case of the earthquake-driven Fukushima disaster or the terrorist attacks at the Twin Towers in New York back in 2001. But type 2 crisis also emerges brutally. It can be unprecedented, but it could have been expected. For example, in 1999 Asian banking crisis depicted by Paul Krugman as in fact a governance crisis. The 2008 financial crisis, which came after 15 years of banking deregulation. And in fact, the COVID-19 crisis came after a number of reports as early as 2005, including the Bill Gates famous TED Talk in 2015 or the World Bank 2016 facility, and recently, in October 2019, the Crimson exercise of the ISP. Well, where did we stand yesterday? Well, the global pandemic crisis erupted at a time of a very fragile global macroeconomic environment, with a threefold stress, a sharp drop in oil prices, a large increase in debt, and declining GDP's growth, the so-called secular stagnation, which has been analyzed by Hansen, by Gordon, and by Larry Summers. Let's keep in mind that Germany was already in recession in the last quarter of 2019, while Italy was tipping into recession before the COVID-19 crisis. Now, if we look at debt ratios, well, we see that the ratio of debt to GDP in the world reached 300% after one decade of rising debt, both households, corporate, and governments. But if we look only at public debt, for most countries of the OECD, with the exception of Germany, of South Korea, of Poland, and of Chile, we have ratios of around 100%, in fact much higher for Greece or for Japan. And that's the consequence of the 2008 crisis, with a decade of cheap central bank money, the so-called QE, and very low rates of interest. Now, let's keep in mind that the starting point for the mounting debt to come in 2020 and 2021. Not only public debt, but the COVID-19 pandemic also comes at a time of rising corporate debt. In the US, for example, non-financial companies owe almost $10 trillion of debt, double the amount those companies owed 10 years ago, including, of course, in the shale gas industry. But think also of the US student loan debt that reaches today close to $1.6 trillion. Now, if we add together private and public debt, one obtains an impressive picture of very large debt ratios for both developed and developing countries. The average is around 250%, and we have ratios up to 4 times GDP in the case of the Irish economy. Now, whatever it takes, liquidities will be used to fight the crisis, but where will the financing come from in regard to large scale fiscal stimulus and balance sheet support? Well, there will be mainly three sources of financing with a number of tools, including central banks, the ECB, Bank of England, and the US Fed, financial markets, bonds, and IFIs, international financial institutions. The central banks will use a wide range of monetary tools, including loans, guarantees with leverage, subsidies, and also debt monetization, mainly for the BOE and the Fed. For example, the UK Treasury can use its direct overdraft with the Bank of England rather than immediately going to financial markets, hence with less pressure on yields. Well, there is an interesting debt dynamics, a so-called engine driving debt ratios up. Now that has to do with a number of variables, mainly the rate of interest, the growth rate of GDP, and the fiscal deficit, that is, the financing requirement. In the case of France, for example, budget revenues will drop by as much as 45 billion euros in 2020. So there is a sort of race between several variables that work in opposite direction. Most countries in the world have taken fiscal actions amounting to close to $8 trillion. And in addition, there has been substantial monetary measures in each of the G20 countries and outside. The IMF alone stands with a $1 trillion facility at the service of its membership. Well, looking at tomorrow now, this is adding the impact of debt-financed budgetary stimulus post-2020, we see a very large increase in debt ratios for most of the OECD countries, but also including for China, by the tune of roughly 15 up to 20% for countries such as Italy and Spain. This very large debt overhang can be mitigated by, for example, using low rates of interest, probably for the next 3 to 5 years. Number two, central banks will keep purchasing bonds, corporate and sovereign bonds, in order to lower yields. A few central banks, such as the BOE and the Fed, will use straight debt monetization. Inflation also might play a role in increasing the denominator of the ratio, that is, the nominal GDP. Emerging market countries will use a combination of soft loans from governments and also from multilateral lenders, World Bank, IMF, but also debt reduction with the Paris Club and the London Club. And last but not least, a global economic recovery, which will not take a V-shaped turnaround, probably a U-shaped turnaround, will also increase the denominator of the ratios, namely GDP, but not before the second semester of 2022, very, very probably. Now, the financing picture gets a bit more complicated. And why? Because financing requirements are so large that they will be met, partially at least, in the financial markets, and that gives a central role to rating agencies. This sector is dominated by three main companies, namely Moody's, S&P's, and Fitch. Now, a rating is simple. It shrinks a large number of variables into one single grade. It allows useful cross-country comparisons and across time. But in the meantime, there is a risk of self-fulfilling prophecy. It is simplistic and it has little predictive value. So the timing of rating actions needs to be carefully calibrated. For example, a few weeks ago, South Africa has been downgraded to junk, and that will complicate tremendously its access to the financial markets. So we have a dozen countries with very recent negative revisions, and another dozen countries with credit downgrading in the last few weeks, March and April 2020. Now, a wave of credit rating downgrades will probably deepen the funding crisis for both companies and countries, with the risk of spreading it to other markets. Without any willing buyers, the risk is simply a panicked sell-off, and that would, of course, have the risk of a snowballing effect. And I'm not sure that the downgrades could counterintuitively be seen by the financial markets as recognition that governments implement swift responses to the crisis, as some people wish. Well, credit rating cuts can be potentially devastating at any time. But when markets, are in panic and cash flows are shrinking, that can lead to snowballing effect and crisis contamination. As we can see here on the chart, there is not much blue. In fact, the trend today looks very similar as in the previous crises of 1999, 2001, and 2008, which means a flood of credit downgrading already in the first 4 months of 2020. Well, what can be the solution? The worst scenario would be repeating the myopia of rating agencies in the previous crisis and then abruptly cutting credit scores, hence leading to a market panic, herd instinct, and making credit more expensive. Now, there may be 2 ways to look at it, to look at this challenge. Number one, sort of wishful thinking, hoping that rating agencies will be more responsible, more patient, will change their econometric models to incorporate the positive long-term impact of fiscal stimulus programs and debt-financed budgetary deficits. After all, a deficit, is in itself is not bad, provided it stimulates investment and consumption, and it is conducive to economic growth, and provided, of course, it is financed with long-term debt at low rates. And that's exactly what is being done today with the help of IFIs and central banks. And 2, the utmost priority should be done to isolate debt-financed economic recovery in 2020 from the scrutiny, the myopic scrutiny of rating agencies, for instance, with regional debt mutualization in the EU, but still resisted today by Germany, by Austria, and by Sweden. But using also the leverage of public guarantees, using co-financing facilities with governments or also with the World Bank, or European bonds, that is the so-called Corona bonds. Otherwise, given that governments have little leeway on rating agencies, one cannot eject the jury from the markets. Well, and given that a rating truce is unrealistic, the risk is that rating agencies will continue fueling crisis contagion. Thank you.